When we look at the trajectory of Fed policy since the onset of the global financial markets crisis of 2008, there has been a clear pattern of the Fed consistently failing to deliver on any guidance that has leaned more to the hawkish side. This goes back to Bernanke and extends through Yellen's term, well, at least right up until the very end of her term. This is an important point because the fact that we are starting to see signs of change on this front is sending a message that the market needs to get ready for the return to times of old, when direction in markets wasn't exclusively tied to Fed policy and when different currencies and asset classes were far less correlated to all things Fed, trading much more on their own underlying fundamentals. This, of course, is what we want to see, as it means we are getting back to something that feels more normal, and we are getting back to a place where volatility is no longer suffocated by central bank tactics. At the end of 2016, the Fed was calling for 3 rate hikes in 2017, and heading into 2017, the market did what it had done for the many years before that, which was to call the Fed's bluff and bet there would be yet another under-delivering of such promises. But finally, in 2017, the Fed did what it said it was going to do and delivered those 3 rate hikes. This was a pivotal moment as it put a stamp on the initiation of the policy normalization process, a process that would eventually start to weigh more heavily on risk assets that had been rocketing higher on aggressive, unprecedented policy accommodation. Now, as with many things in life, the fact that the shift had begun didn't mean we would see an immediate reaction. The added wrench of U.S. protectionism and soft dollar policy didn't help this cause either. And yet, we are in the process of seeing this big shift to the point where not only is there more of an expectation the Fed will deliver on forward guidance, but that it may even over-deliver. The market was still thinking 2 hikes for 2018 earlier this year, despite calls from the Fed for another 3 hikes in 2018. But then it quickly came around to getting on board with those 3 rate hikes, only to now digest talk of the possibility for 4 rate hikes in 2018. And so the pattern of over-promising and under-delivering seems to have been broken, with the Fed transitioning to a place where we could be getting ready for under-promising and over-delivering with respect to policy normalization. It's clear the risk of rising inflation adds to this possibility, and it will be important to see where these readings come out in the weeks and months ahead. As far as today goes, the Fed is widely expected to raise rates 25 basis points for the first hike in 2018, and the market will be reacting more to any additional insights offered relating to that rate hike path looking out to the rest of the year and beyond. This means keeping an eye on the economic forecasts and dot plot. It's worth noting that after inflation metrics were showing signs of jumping earlier this year, in recent weeks these metrics have cooled off, which many believe will keep the Fed from getting too aggressive on any 4 rate hike talk. But right now, whatever the case, the key takeaway is that the conversation has shifted from one in which the question is about whether the Fed will let down forward guidance to one where forward guidance is expected to be met with the possibility for an adjustment that produces something even more. As we referenced earlier, this is a big deal, particularly for the U.S. equity market, as it means we are now in a place where higher rates need to be taken more seriously and should make those valuations less and less attractive, ultimately resulting in a capitulation that is well overdue. If we look at the S&P 500, we believe a correction that takes the index back to the 2015 high around 2140 is perfectly reasonable in 2018, which would translate to a fall of 25% off the record high. As far as the currency market goes, it has been a lot tougher to figure out, with this ongoing curveball that is U.S. administration policy complicating any flows that would otherwise be highly supportive of the U.S. dollar on yield differentials and safe haven demand from the normalization of policy. If we look at the euro as a proxy, what is clear is that we have seen a contraction in volatility over the past several weeks, something that does warn of a major move sooner than later, whichever way that move plays out. Right now, a break below 21.55 will be required to open a bigger recovery in the US dollar, while inability to do so will keep the dollar under pressure and at risk of another run of declines to plus 3-year lows against the euro. That's all for now.